Good morning, everyone, and welcome. My name is Will Hartley, Marketing Coordinator with Smoker and Company. I'll be serving as your moderator today. Thank you for joining us for our first webinar in the Smoker and Company 2026 Insight Series. We're excited to have you with us today and appreciate you taking the time to participate in the conversation. For those of you that might not be familiar with us, Smoker and Company has been serving Central Pennsylvania for more than 40 years, providing accounting, tax, and advisory services to businesses, organizations, and individuals throughout the region. Before we get started, I'd like to mention that we will have time for questions at the end of today's presentation. However, if you have a question that comes to mind during the presentation, please feel free to enter it into the chat at any time. We'll collect those questions and address as many as possible during the Q&A session. At this time, I'd like to turn things over to today's presenter, Eric Miller, who will introduce himself and guide us through today's topic.
Morning, everyone. Thanks for joining in today. Like Will said, in the first of hopefully many, entries into our series here. My name, like Will said, Eric Miller. I'm a partner, and a CPA here at Smoker and Company, also licensed financial advisor. Been with the company just about 13 years. Have two children, live in Lancaster, so love to, serve the community, save our clients some money, and that's where this topic came to light. Overpaid income taxes. So, going into that, being an area I'm particularly fond of, getting people their money back, from overpaid taxes. So, today we're focusing on that and specifically how individuals and businesses may be able to get money back through amended filings. So, most people think of tax returns as something that gets filed once and, just kind of turn the page and go into the next year. That's not always the case. Best practice tax returns are based on, information available at the time they're prepared. And sometimes that information changes. Sometimes documents arrive late, you forget about something, a W-2 comes later, an investment statement, on a small account you forgot you might have. Sometimes deductions or credits might be missed, and sometimes you just look over things and say, hey, I missed something. The goal of today is not to suggest that every prior return has a refund, waiting for it. That's not realistic. But what we want to cover is the main reasons, that returns you could have overpaid taxes, help you understand, when a prior year return might be worth reviewing for amendment, are common issues, that we see, in practice that, can create overpayments, and how that process actually works. We'll talk about both individual and business tax situations, trying to keep it practical, easy to understand. My perspective, as the CPA and accounting professional is, high level technical detail, but, we want everyone to be able to learn from taxes and, take away something, from every conversation. So going over, what we want to cover today, why taxpayers overpay. It can be individuals, businesses, or combination of both. And it's not just because, someone did something wrong. It can be incomplete or missing information, like I already touched on. There could be facts that changed. There could be complex tax rules that, weren't researched thoroughly. From there, we'll look at individual refund opportunities, most common things like education credits, dependents, retirement, deductions and credits, health savings accounts, and again, not meant to be all inclusive, just touching on some of the most common items in there. Then, we'll take a look at business refund opportunities. Again, some common items, depreciation, including fixed assets, research and development credits, business income deductions, state apportionment issues, net operating losses, those type of items. Then we'll, touch on what exactly an amended return is, the forms you're usually using as part of that process, and, the process itself for filing them. And then, we'll touch on, one of the most important issues, deadlines. Federal claims, generally have a very strict statute to get those claims filed. So, those are important to make sure you're reaching. Otherwise, those, refund opportunities can be lost. Last, we'll talk about documentation, some examples, common mistakes, takeaways, and, talk about our second opinion program a little bit as well. So, covering why taxpayers overpay. That's kind of the thing that leads us, into does an amendment, make sense in this situation? So, why do taxpayers overpay? Overpayments can come from missed deductions, tax credits that were missed. Maybe you were ineligible for a credit and didn't claim it. You might have contributed to a retirement account, a health savings account. That deduction didn't show up or get properly reported. You may have been, you may have had some credit opportunity available on the retirement plans. Maybe there's some carry forwards missed. There's so many, situations where taxpayers, ended up overpaying. Filing status is a big one. If you go from married to, if there's an unfortunate passing in the family to a head of household situation, if you're not aware of some of those rules, you might file a single instead of head of household costing money. You know, and going from there, businesses can overpay in different ways as well. There can be, expenses that get missed, that might be common in your line of business that you just didn't think of. There can be, capital expenditures like assets, that are deducted but not fully deducted or deducted as well as it could have been. There could be incorrect depreciation methods used, overlooked credits, income double reported. That's a very common situation, or in the wrong year. And, looking at another thing that changes, last year we had a big tax law change. The One Big Beautiful Bill Act came along and threw things a little bit on their head. We had some depreciation changes, bonus depreciation changes. That IRS guidance and interpretation on those rules from the law can change. It's constantly changing. One of my favorite quotes is, tax law is written with a pencil and eraser. It can change, and it changes often. So, they have changed significantly, in the past even 10 years, and businesses in particular have a lot of moving parts. They have payroll, their assets, entity level elections, state filings, pass through, ownership income items that get, passed through to the individual that owns them. And that can affect everything on the individual side of things. So, from a CPA perspective, the main takeaway here is the tax return's only as good as the information you had at the time and the analysis and guidance that was available at the time as well. Again, that guidance can change. So second review isn't just second guessing. It's about looking to see whether the return accurately reflected the taxpayer's information and available benefits at the time and after that fact. So, looking at individual refund opportunities in some more detail, some of the most common areas we see, as far as things that change and are available to individuals, after initial filings, starts with education credits. If you have a child, dependent in college, you're very often able to claim, tax credits related to that tuition and your required education expenses. So what qualifies as very technical, certain things like room and board don't fall under that, but the eligibility depends on the type of expense, who the student is. There's income limitations on the parents that can affect that, and whether someone else already claimed the credit. There's a lot that goes into it, and it's an area that it gets frequently either missed or messed up as a result. Another area, also relating to children is child and dependent benefits. There's credits available, if you're paying for daycare or summer camp, for children, that are dependents of your return. And those credits as well are very fact specific. Small changes in your household income and information can affect whether those credits are available or not. Another big one, is energy efficient home credits. If a taxpayer made qualifying improvements, windows, doors, geothermal systems. There can be tax credits available. And, a lot of times the salespeople, make you aware of those, but there's a lot of times they don't. So, they're just another example of an item we see, that has some tax implications, but, isn't always on the return. We also like to look at, retirement contributions as well as health savings account contributions. Both of those, have opportunity available to reduce your taxable income. And those forms, are, for the retirement forms, those are referred to as Form 5498. The due date on those is until May 15th. Well, that's a month after tax returns, or get past their original filing deadline. So, that's a frequent area we see, someone said, oh yeah, I got, all my forms handed in. That comes a month later, after you file, and there could be some deductions available. Another area, that's affecting the individual side more, flowing from a business item is capital loss, carryovers. You can have some investment losses, and there's limits, how much can be deducted in a single year on those losses. So, if that carry forward is missed, not properly rolled forward, it could, lose you out on 1 or more years of extra benefits. Self-employed individuals, we look at business expenses, particularly home office deductions, mileage, supplies, software, professional fees. We're not going to name every expense that exists for, self-employed individuals, but, there's a lot of, expenses, and we like to look at, hey, what are some common areas in this person's line of work where we should see an expense and do not, follow that up with a conversation. Hey, do you travel for work? Or you're deducting your mileage expense? Do you have an office in your home, that you're utilizing for business purposes only? Those kind of questions, and having that relationship, helps us really narrow down, hey, are you, deducting and getting the maximum legally allowed benefit you're entitled to? Another item, thankfully it's less common, but corrected income information can also come through. Corrected W-2, a corrected 1099, a corrected form from an investment brokerage statement, income, interest, dividend income, gain or loss information. Those will sometimes have corrected forms come out, and at that point you're almost forced to amend your return if you've already filed. So just as a summary, the main thing, don't assume that the first filed return's automatically final. There can be so many things that come after the fact, that are reviewed or found after the fact, or that just got missed, and that you're able to follow through this process to, claim and, get those tax benefits you're entitled to. So, turning over to business refund opportunities, the businesses tend to have a little bit more complexity, than individual returns. They can involve accounting methods, assets, equipment, vehicles, those type of items, payroll, certain ownership structures, state filings, pass-through reporting to the owner. So, there's a lot of areas that intermingle here for self-employed owners, but there's also a lot of items that, as a business level can be available that aren't available to, someone that's an employee gets a W-2. So, as one of the most common areas we review is depreciation and fixed assets. The business could have bought equipment, vehicles, those type of things. Proper classification, makes a huge difference for those items. We have accelerated depreciation available where those items can be deducted, up to 100% in year one. But, sometimes we'll frequently see, the wrong asset life assigned to something, which limits options and limits your tax benefit. So, those classifications, can lead to deductions being understated, and sometimes it may only affect that tax year. Sometimes it may affect many tax years. Another area, research and development tax credits. When most people hear that, they're thinking, pharmaceutical companies, those type of big players. But Many more businesses qualify for that tax credit than most people would assume at first glance. It's not just labs or tech companies, manufacturers, engineering companies, software development companies, product design. Many other industries can have activity that qualifies for that credit. It's a highly factual area. You need a lot of good documentation for it. But at the end of the day, that doesn't change whether you qualify or not. So, it's important to have those discussions, with a trusted advisor that can help determine, do we meet these requirements to claim that benefit? We also look at, the qualified business income deduction. Gets shortened as the QBI deduction or the 20% deduction, kind of the common, language for that. For pass-through businesses, certain, self-employed taxpayers can be a very valuable deduction, generally worth 20% of your qualified income for that. But it can be complicated, for higher earners, you can have limits based on your wages, property. There's certain lines of businesses like legal and tax that are referred to as specified service businesses, which have their own set of rules. So not very, at the end of the day, it's simple on the surface, 20% qualified business income deduction, but there's a lot of nuance to it and a lot of rules-based, information that needs considered. Another area is, state apportionment and allocation. Businesses operating in more than one state might overpay, if their income is assigned to a higher taxing state compared to a lower taxing state. Some of our neighbors, Pennsylvania, thankfully has a pretty low income tax overall at 3.07%. Some of our states like New Jersey, can jump up to close to 9%. So, if income is assigned to the wrong state, you can end up paying that 6%, premium between the two states. We also, look at net operating losses. We frequently call them NOLs, net operating loss, just shortening it down. A business loss in one year might affect other years. You have carry back and carry forward options, for qualifying agricultural businesses. So, it's another reason where, hey, you might have a return 2 years ago that might be affected by your current year return. You have the option to carry back a loss if you're a farmer. So, that's just another example of where a return properly filed might still have a change from a later filing. Expense classification is another common area. There might be costs such as, Christmas parties or, office anniversary type parties. Some of those expenses, if they were just classified as meals, may only have had a 50% deduction when in reality, 100% deduction was more appropriate. So, we also want to look at and review items like that, that have a, effect on taxable income. So at the end of the day, from our perspective, the review is not just about finding one-time refunds. It's about getting the tax treatment, correct, whether it's now, whether it's in the past, and moving forward so it doesn't repeat the same issue year after year. So going into what do we do about this when we realize there may have been something missed, information changed after the fact? Well, that leads us to amended returns. So, an amended return is really just, the way to correct a return that's already been filed, covering those multitude of reasons why, income, deductions, credits, filing status. This is just saying to, the IRS and state and local taxing agency, hey, we filed this before, we're filing this amended return. Here are our changes in short. So, individuals, they file Form 1040X. That's correcting your individual returns, and their various series, 1040-SR for seniors, 1040-NR for non-residents. The 1040X is the form used to, correct and amend those forms. Simplified, it shows an original column, it shows a change column, it shows the adjusted final column. So it's a very visual form as well. Corporate entities, they'll generally file a Form 1120, an amended Form 1120 to correct that. S corporations and partnerships, they file amended, 1120S forms and Form 1065s. Partnerships, whether it's a separate form, as well as or just, checking a box that says amendment. The rules differ a little bit there, but in short, it's filing, that corrected, form to show here's what changed, here's the final information to make that change and make it correct. Last state amended returns might be needed. Some rules are federal only. Other rules, would affect federal and state. Some might be state only. So, that's something, want to look at. If a federal change affects the state should be also reviewed as part of our process here. So, moving along the amendment process itself, first you want to look at the original returns. We look at what got filed to the federal, to the IRS, the state returns, supporting schedules like depreciation, reports, your K-1 forms you may have received as a business owner, W-2s you may have received as an employee, 1099s, financials, those type of things. The second steps to look at, comparing that source document to the returns filed, what was missed, what was reported incorrectly. A lot of times, when we're looking and talking to taxpayers, on their prior returns, we end up just going into, those discussions with a lot of questions. Did the year really look this good? Did you buy equipment this year? Was this the equipment you bought? Was your income overstated? Were deductions missed here? Were there, equipment you bought that might have, qualified for credits like solar systems? Did depreciation get calculated correctly? So a lot of times that discussion is what leads us in to realize, okay, these are the things, that were either missed or not optimized on that filing. So, from there, step 3 is really just, hey, gather the documentation, figure out the exact amount of the adjustment and, calculate what the corrected tax would be, figure out if that change produces a refund, a balance due, affects carry forwards or carrybacks. And, we want that support. That support could include like receipts, your invoicing, banking records, expense, invoices, that type of thing. So, at the end of the day, you want to make sure that, you have your ducks in a row, your I's dotted and your T's crossed, before you move forward with filing that amended return. Step 4, preparing and actually submitting them. Kind of just briefly covered those various forms that can be included, but you want to prepare, those amended forms, and you want to explain the change clearly. At the end of the day, the IRS, the people processing the forms, they're obviously looking for wrongdoing, but hey, if you clearly lay out, here's what changed, here's why that changed. Hey, I received a corrected form W-2. I'm amending, to reduce my income based on this corrected form. You want to lay it out clearly so, they can do their job quickly and efficiently. They're people too, they just want to do their job to the best of their ability, get home to their families at night. And, having that good explanation there helps them do that. You have to lay out in that explanation the ground for the refund. You have to include sufficient facts to let them know, the basis you're claiming that refund. And in basic terms, you just need to tell them what changed, why it changed, and how that refund was calculated or balance due. Looking on, IRS and state processing can vary widely once that return is actually submitted. So, from there, IRS says, it can take 16 or more weeks. That's 4 months. So it's not something they move on very quickly, but once it is submitted, they do have an online computer system to, track their steps in the process. They generally confirm they receive it pretty quickly. Processing time can, go on for quite some time. States, it varies based on the state. A lot more states have electronic systems that are able to track that now. Not every state does, though. That's going to be very specific state by state. So, a good return, what we call a good amended return, it's just not new numbers. It's having, the facts there. It's having the documentation that if someone asks questions, we can back it up, and having a good explanation of what changed and why. So looking at, key deadlines and, the statute of limitations. From the IRS perspective, it's one of the most important parts of the amended process. For federal tax refund claims, there's a section of the code, Internal Revenue Code section 6511, provides the general rule. A claim must be filed within 3 years from the return was filed or 2 years from the time the tax was paid, whichever period expires later. So, generally 3 years from when you file, 2 years from when tax was paid, which was later. So, that's the rule most people hear, the 3-year, 2-year rule. But there's also, a look back limitation. Even if the claim's timely filed, the amount that can be refunded may be limited based on when the tax was paid. If the claim gets filed in that 3-year period, the refund's limited to tax paid within the prior 3 years plus the extension period. But it's not filed within the 3-year period. But if it's within the 2-year period, the refund generally is limited to tax paid within the prior 2 years. So it's very technical, but it boils down to don't wait too long. It can cost you refund opportunities. There's certain special rules which might extend that, claiming time. But the general takeaway is timing matters, and timing matters significantly. If you think something's wrong, bring it up, to your tax professional. If you're filing something on your own, don't wait. It's better the sooner you start looking at those type of things. Documentation, that's what turns, a possible refund into a supported refund and successful claim. Having, those corrected documents, having, what changed handy is important. A refund, isn't automatically gonna get looked at, but it is possible the IRS or the state, refunds that you're filing for may request additional information. So it's good to have that information handy, before it even gets submitted. Then when they ask, it's good to go. Helps make that process smooth. So, going to some like illustrated examples and some case studies, and we've had a lot of them, but, let's just kind of assume a taxpayer filed a return, later realized that they qualified for an education credit. They have the tuition information, proof of payment, eligibility requirements all got met. In that situation, our process is have that conversation, which, dependent claimed on your return was it? Were they a full-time student? How old were they? If we don't already know that information, look at the original return, confirm whether the credit was omitted or not. Maybe a different credit was claimed instead. We want to take a look at income limitations, dependent rules, and calculate corrected tax. Then, once we confirm it's available, the documentation's there, we're within the filing timelines, we would file that 1040X form to claim that additional refund. So looking at, just a separate example, business taxpayer, business purchase and equipment, they did some leasehold improvements, but the fixed asset schedule classified the equipment as a leasehold improvement instead. In that situation, depreciation deductions could be understated on that original return. We would review, hey, what was purchased, what was their descriptions, when they were placed in service, those assets, how they were deducted originally, and what we could do to, deduct them more optimally or correctly. That classification can make a difference between a partial deduction or a full deduction, for equipment or other items as a business point. And from there, we'd also want to make sure, hey, we're not costing ourselves deductions that might be more valuable in the future. So it's not just about now. We also want to look to, what might be more beneficial in the future as well. But that's just a conversation to have, with your tax professional. Looking at some common mistakes to avoid, first is just waiting too long. We don't, talking about that statute, that's strict, can't wait too long. If you miss that filing period, you're generally out of luck. So, get those refund claims moving, if something changed. Second mistake, filing without documentation. You want to have, again, all the ducks in a row, I's dotted, T's crossed. It's a very common request. IRS and the state might ask for additional documentation to support any type of refund claims. And speaking of the state, we don't want to ignore the state. Amended returns might affect federal side, but, they might affect the state as well, which, could have an effect on your tax, your credits, what state things are being assigned to if the business operates in more than one state. And, sometimes the state refund can be just as, if not more important than the federal side. So, it's something to, take a look at as part of everything else. Fourth, overlooking related tax years. Some credits can be carried back, some deductions can be carried back, others can be carried forward. You want to look, at all the years those items would apply to, not just a single year. Looking at one year, you can miss the full picture. You don't want to do that. Fifth mistake, incorrect calculations, using the wrong forms. At the end of the day, those calculations, you want to make sure they're correct before any kind of, amended return gets filed, whether it's for a refund or whether it's for additional tax due. And then last, again, assuming prior returns are error-free simply because it got accepted. There's many instances where a return can be correct, but you could have a current year item that has the opportunity to be carried backwards and might be beneficial to do so. So, those type of things are something, we're always keeping an eye out for our clients. But, if you file on your own or, work with another practitioner, just because something got filed doesn't mean it's always the most optimal way to be filed. So, looking at the key takeaways, overpayments, can happen for a lot of reasons: missed deductions, missed credits, corrected documentation, incomplete information. But, the IRS and states have that, opportunity to correct that information through the amended filing process. Those amended filings are the formal way to correct those issues, and the prior returns. The actual process itself depends on the type of taxpayer, the type of return. Refunds aren't always obvious. Those deductions, missed credits, there can be items that qualify for carry back, might benefit you more than carrying it forward. Those amended returns can help you, correct those prior filings to get that most optimal result. Documentation's very important. Those refund claims need to be clear. They need to have a good explanation. You need to have the support to back it up. And last, professional reviews can help determine whether there's a real opportunity, whether there's something that should just be corrected based on corrected forms received, future planning considerations, or, hey, maybe we could get $500 back, but maybe the cost is about the same. Well, at that point, maybe we just want to pass on it. The cost savings aren't there, to benefit you. So, last, as a company, we've had our second opinion program for, a very long time now. It's designed to help individuals and businesses take a fresh look at prior year returns. It generally starts, we review your filed returns and supporting information for the prior 3 years. We look for things like missed deductions, unclaimed credits, reporting inconsistencies, depreciation issues, state tax opportunity, and a lot of other items that we might want to have a discussion on, or come into a meeting with a lot of questions to find out more of your business. If we have an opportunity we identify, we look at, hey, here's what we found, here's what we'd estimate the benefit to be, what we'd need for documentation, what kind of deadlines we have, and any risks, that might, apply before we move forward. And it's not to file, the whole point's not to file an amended return unnecessarily. It's to make sure your prior filings are accurate and you're not leaving, benefits you're legally entitled to on the table. So if you think you might have a prior return that deserves a second look, or if you got corrected tax documents, major business transactions, changed advisors, or want more confidence, hey, everything looks good, we'd be happy to have a conversation. So thanks again for joining today's presentation. We do want to move into, any questions and answers. If any questions got submitted, Will's going to go through them now. If there might be some we might want to have a follow-up conversation on, if it's a little too technical to get into just in kind of a general discussion, we might do that. But Will, take it over and what do you have?
All right. Thank you so much, Eric, for an informative presentation, for sharing your insights with us today. We'll now move in. I know we're running a little bit late here, but we'll now move into the Q&A portion of the webinar. If you have a question, please feel free and submit it via the chat, and we'll address it as many as we can. To start the discussion, Eric, can you share an example of a recent situation where a client benefited from amending tax returns?
Yeah, absolutely. So, one of the most recent, situations I had where a client benefited, it was a farmer and they, had a lot of agricultural buildings they, put on their farm. They put up a dairy barn, they put up a general purpose barn and, did some related, groundwork, as well relating to those. Well, in that situation, agricultural buildings, it depends a lot on what the building's used for. The tax code has a lot of nuance built in that if buildings are single purpose buildings, they allow the farmer to write those off over a 10-year period of time compared to a building that's general purpose in nature, storage barns, over a 20-year period of time. Well, that taxpayer, the single purpose, heifer barn they built, was classified incorrectly as a 20-year structure. And because of that, their state taxes ended up overpaying more than they needed to. Pennsylvania law, allows you to, take Section 179 if it qualifies for federal Section 179. 20-year assets do not for the state. So we were able to get that client, about $5,000 back, as a refund, just by changing that life. And now, with that corrected, life that qualified for additional deductions and state level tax credits as a result.
Perfect. One other question. How long does the amended tax return process typically take?
Yeah, so it's going to be one of my favorite answers. It depends, but IRS generally will say, anywhere from 16 to 20 weeks at a minimum, and you're looking at 4 or 5 months. So, most states tend to, kind of mirror what the IRS does as far as timing. It's going to vary state to state. Pennsylvania typically says, 8 to 16 weeks. So they say a little shorter. In actuality, you're probably, if you file an amended return, you're probably not going to hear back before 5 months at the earliest.
And I think we'll have this as our last question for today, but
Yep.
many taxpayers worry that filing an amended return will trigger an audit. Is that something people should be concerned about?
So it is something people should be concerned about, but not as much as they are. At the end of the day, amended returns, what we frequently see, IRS or state taxing agencies might ask for additional information regarding the change itself, but not a full-blown audit. That's very rare. Those typically tend to be, related to, specific issues or a random chance. But what we've seen historically, if IRS or state's going to ask a question, it's going to be very targeted towards the change that was made on that amendment or asking for specific information supporting that change.
Wonderful. Thank you again, Eric. And with that, we'll conclude today's presentation. We hope you found today's session informative and valuable. This webinar is the first in our Smoker and Company Insight series, and we look forward to bringing you additional topics and insights in the future. If you do have, as Eric alluded to, if you have any follow-up questions or would like to connect with our team, please don't hesitate to reach out to us. And on behalf of everyone at Smoker and Company, thank you so much for attending. We appreciate your time and participation. We look forward to hopefully talking again. Have a wonderful day.
Thanks, everyone. Bye now.
Thanks so much.